let's discuss some of the issues in the economy. One of those is a lot of economists believe that the successes that we had in the macroeconomy last year was because there was a reduction in the money supply. We'll find out what financial derivatives thinks about this. Another issue we have here, a manager from financial derivatives company, Dumebi Oluwole. Miss Dumebi, Happy New Year.
Happy New Year, Amy.
Mrs. Dumebi, actually Mrs. Oluwole, so let's not get too familiar. Well, I spoke to Mr. Ruwani, late last year, and he attributed the issue of money supply to some of the successes we saw in the macroeconomic data. So I wonder what else you can tell us about that.
I mean, we have seen money supply growth actually decline, coming from 2024 up until last year. And like he mentioned, the reason why we saw this, significant decline is coming from about 75%, at some point even got to 79%, right, in money supply growth. Now we're down to about 10-12%, right? So that's a significant drop compared to where we're coming from. And when you break down the money supply numbers, you realize that, okay, cash in circulation was one of the factors, right, that was driving money supply growth.
And that fits into inflation, I guess.
Of course, that also feeds into inflation. And then you look at the other side of it, where there was some issue of ways and means advances that propped up the money supply in circulation, and of course money supply growth. And then you also look at money market liquidity, that is the liquidity within the money market, interbank market liquidity, and that of course also pushed up money supply growth. But due to some of the changes that we have seen on the monetary policy side, that number has declined. However, when you look at
would that be the hawkish stance of the MPC?
Oh yes, of course. So when there's an increase in interest rate, remember the simple definition of inflation is too much money chasing too few goods. And when you look at how monetary policy is supposed to help reduce that too much money in circulation, is through setting adjustments with money supply or monetary policy tools. And then that's where you see things like OMO issuances, where it's pretty much cash in exchange for a security. And that way we're reducing the cash moving in circulation. Then you also consider the increase in interest rates, where that of course made fixed income securities more attractive, and that to some extent is supposed to help mop up the excess liquidity, excess cash in the system, where there's an exchange again, of course, for cash in place of tradable securities. Then you also consider other aspects like the central bank also adjusting the CRR, adjusting the asymmetric corridor to somewhat contain that money market liquidity, keep interbank interest rates high, so that banks are incentivized to, reduce the cash that is within the system. So those are some of the measures that we have seen.
But at the elementary parts,
yes,
do we see a factor such as more Nigerians adopting e-transactions?
Yes,
I
was getting to that. Yes, I was getting to that. So we have seen that, of course, support the decline in cash in circulation. Pretty much by the time if you check yourself as of today, how much cash do you really have, with you? So that ideology, all of those technological changes that we have seen and adaptation we've also seen at the consumer level, right? Those are some of the things that we have seen reduce the cash in circulation. There's a very strong adoption, through e-payment channels. When you look at NIP, that's transfers. You also look at POS movements as well. We see all of these changes.
And we saw new guidelines for POS operators towards the end
of the year, by December 2. Yeah, that was the circular on cash withdrawals. And it wasn't necessarily only for POS, pretty much. It was primarily on cash withdrawals, right? And what that was supposed to do, what that is trying to do as well, is kind of course, contain that movement of cash within the system, because there is now a processing fee if you extend or you go beyond your cash withdrawal limit, for an individual, which are, I think, 500,000 naira for a week. Per week, and then 5 million naira for businesses. When you put all of this side by side, the recent tax reforms reforms that have come into play and how that is, of course, reorientating the entire macroeconomy, we see that there's more leeway for people to adopt more technology into their business operations and into even their daily lives, right? So less cash handling, more of transfers, and of course more neat transfers. I mean, we're seeing a lot of memes
Yeah,
go around.
but I
Yes,
mean, let's not be all negative.
of course.
During the year, we did see the movement of fintechs. From I think to NPS, that's what they call it, which is supposed to, and even the banks themselves. I know there was a time there was a whole lot of disruption,
yes,
in the banking system for e-transactions. But
yes,
after that, things calmed down.
Yes.
So I guess technologically things are better, and
Yes.
people should trust the system even more.
I mean, there's a lot of disruption going around, both on an industry level and on a policy level, right? And those are the things that, of course, excite people like myself when we see all of these changes happening. So you're right in that. Of course, there was some change that happened within the banking. I mean, people, of course, felt it. I felt it. We couldn't transfer for a while and all that. But then we're also seeing
their money
some
stuck.
But I mean, all of those changes are now getting better. And remember that when the reforms started happening, when we start from when the telecom tariffs, when conversation around telecom tariffs came into play, that was the major one. And the conversation, even I came here and said that the expectation is that after all of is said and done, the expectation is that the linked sectors that benefit from a better telecoms environment or a better telecoms industry, we were likely to see better services. And pretty much that's what we're beginning to experience. Can it be better? Of course. Will it keep getting better? The expectation is that it does, right? So because if one industry is doing better, the expectation is that the linked sectors are also doing better. And financial services is a huge beneficiary of when the telecom industry is doing better, and that's what we're beginning to experience. The other bit of it is the disruption from fintechs. Now, everybody knows about market share. Fintechs are literally addressing the need of the common man, from POS merchants to you being able to open a bank account just with your phone number, right? And we're also seeing banks try to meet up with this pace. We're also seeing deposit money banks trying to meet up with this pace. At the end of the day, healthy competition is what drives market competitiveness, and definitely continually to push for better policies, better consumer protection, and ideally a better macroeconomic environment for both industries, companies, and consumers.
So another thing that we saw in 2025, which I don't know if we'll see in 2026, was at the beginning of the year, the government was very active in the fixed income market.
Yes.
And we saw the yields were really high and all of that. We have, of course, I think we have about 23 trillion deficits in this year's budget also. I wonder if we will see the government active to maybe at the beginning of the year and then maybe cool towards the end of the year.
I mean, we do think that's going to happen. We do think that that's going to happen. Reason being that there is, number one, the likelihood to reduce international debt exposure, right? So that we're not so exposed. And number two, our debt servicing obligations are not as high. So the chances are that the government would want to raise debt from the domestic market. So we might see an increase in T-bill issuances, more bond auctions. I mean, at the end of the year, between October and December, we did see, bond auctions come up, and we expect those to happen. One thing to do note is that we might see more industry-focused bond issuance. For instance, infrastructure bonds. Might see things like that, green bonds, things like that are supposed to, number one, encourage some kind of fresh capital to come into the system. Reason being is that the government, we have seen, is trying to push on itself for international funds to come in, but international funds to come in a way that international players want to invest. And that's when you talk about climate financing. So things like green bonds for certain sectors, especially maybe towards the oil and gas industry, or even the tech industry, might see those things come up. Infrastructure bonds as well, likely to be a case where we would see an increase in that coming up. We're also likely to see, again, fixed income T-bill issuances coming up. But the interest rates on those, the yields on those T-bills might not be as high as we experienced in 2025, at the beginning of 2025. Reason being that we're now operating in a seemingly different monetary policy environment. So we do not expect rates to significantly decline or the central bank to be extremely dovish, but we do expect that we might see some status quo, minimal rate reductions, because why inflation is already inflation is declining, at least from what the MBS numbers are saying. And that consolidation between monetary policy and fiscal policy has to be there for investors, to signal to investors that we are operating in a market-friendly environment.
What about the Naira?
Yeah.
Where do we expect
the
it to
Naira.
be? Have we gotten to our best at under 1.5?
Well, I would say that there's a lot more at play when it comes to the Naira, especially when you consider all of the dynamics that are happening with the international and geopolitical environment, and how that would impact the Naira going forward. But we do think that I do think that the Naira will stabilize. So I think we're at a point
stabilize at the point
we are currently. Yes, okay. I think at the FX market we're at a point of stability, not really a point of aggressive appreciation. And I think the markets are fine with that. Reason being is investors, business owners now have more trajectory to plan. So you do know that when there's an increase in demand, right, the markets respond to an increase in supply. So there's not so much of a gap, right, between the parallel market rate and the official market. I mean, towards peak periods, like we did see in December, where the parallel market was around 1,409 to 1,485, and we saw the official rate at 1,435, 1,430. We did see that gap kind of widening, but there were several factors that explained that, and so it didn't rattle the markets in any way. Pretty much all I'm saying is that we expect it to be more of a stability than aggressive appreciation, except the fundamentals around geopolitics and our exports significantly change. Those are the caveats on there.
What about commodities? I mean, last year was much celebrated. We saw bags of rice flying everywhere in December. What do we expect?
So for commodities, expect that we might see this trend continue. Remember that the trend of an increase in commodities and then a decline in prices. Seasonality will still take its toll. We do expect that to happen. During the planting season, we most likely would see prices, rise. Certain commodities will be scarce during their planting season. I always talk about plantain because that's a very, very core commodity to my heart.
To your heart.
But then, so when the season for plantain, happens, we expect it to, be scarce in the market and price to increase. And especially because we have not yet fixed the fundamentals around logistics, around increasing supply around the year. But with imports being more managed and we are seeing more value addition happen, though at a slow pace, happen across the agric value chain, we expect at least the staple commodities like rice, yam, to constantly be in the market. And remember, we are in a very interesting year. 2026 is an election year, so we do think that there will be efforts.
And there are fears too that, I mean, this progress, whether slow and steady, we might call it, that we're seeing might be disrupted this year. But we hope that our political leaders will give us more attention than their political careers.
I mean, I will say this, that we are in a very, very interesting time where politics now really define the macroeconomic environment. I will say also that it's still quite early to really say how things are going to really be disrupted or not be disrupted, but the expectation is that this is going to be a very defining year for the Nigerian economy on a macroeconomic level and even on a socioeconomic level. And both business owners, investors, and consumers, of course, have to watch very clearly and carefully, and of course, plan themselves accordingly.
All right, Dumebi, thank you so much for that. Manager, Financial Derivatives Company, Dumebi Oluwole.
Thank you. Thank you for having me.